All right, let's get right into it. Picture this. You're 17, you've just aced your driving test, and you've finally got the keys in your hand. That freedom is awesome, right? But, with that freedom comes a whole lot of new responsibilities. And, well, sometimes things don't go exactly as planned. So today, we're going to crack the code on what actually happens when you need to use your insurance. So imagine you're backing out of a tight parking spot. You're being super careful, checking all your mirrors, but then you hear it, that awful, sickening crunch. It's just a little fender bender, but your stomach just drops. And your first thought isn't about physics, is it? It's about your wallet. Who is going to pay for this? This whole what if situation is exactly what insurance is built for. It's all about something called risk. Now, for your exams and in the real world, risk isn't just some vague feeling of danger. No, it's super specific. It's an unpredictable event that causes a financial loss. That car crunch, yeah, that's the perfect definition of risk. So you're probably thinking, phew, no problem. I have insurance. That's what it's for, right? And you're right. It's there to protect you from that financial loss. But here's the big question. Does that mean the insurance company just hands over a blank check and pays for every single ringgit of damage? Let's find out. Okay, the very first word you need to burn into your brain is deductible. So what is it? A deductible is a fixed amount of money that you, yes, you, have to pay out of your own pocket first before the insurance company even begins to pay a single cent. It's your part of the deal. Honestly, the absolute easiest way to think about a deductible is like a cover charge for getting into a club. You got to pay that fee at the door just to get inside, right? Well, your deductible is the cover charge for your insurance claim. You pay it to get access to the main event, which is the big payout from your insurance company. Okay, let's put some real numbers on this. You take your poor, crunched-up car to the workshop, and the mechanic comes back with the bad news. The total bill to fix everything is a pretty scary 5,000 ringgit. Ouch. So you pull up your insurance policy on your phone, and you see that you have a deductible of 400 ringgit. Remember, that's your cover charge. This is the piece of that 5,000 ringgit bill that you are responsible for. It comes out of your pocket first. So how much does the insurance company actually pay? The math is actually super simple. You just take the total damage, that 5,000 ringgit, and you subtract your deductible, that 400 ringgit that you have to pay. And there it is. The insurance company pays the rest, which is 4,600 ringgit. So here's the key takeaway. You didn't have to pay the full 5 grand, but you also didn't pay zero. You paid your part, and the insurance covered the big chunk. That, right there, is how a deductible works. All right, a deductible for a car accident? Pretty straightforward. But what happens when the disaster is way, way bigger than a dented bumper? What if we're talking about something huge, like a fire at your house? This is where a much, much trickier rule can totally catch you by surprise. Let's talk about the second major player here, coinsurance. Now, this is basically a penalty clause. It gets triggered if you don't insure your property for what it's actually worth. Think of it as the insurance company saying, hey, if you're going to try and save money by undervaluing your stuff, then we're not going to cover your full loss when something bad happens. So here is the classic huge mistake that people make, and you need to watch out for this. Let's say your house is worth 500,000 ringgit, but to get a cheaper insurance plan, you decide to insure it for only half of that, 250,000. It might seem like a clever way to save a few bucks, but trust me, it is a massive financial trap. And here is the absolutely brutal consequence. Because you only insured for 50% of your house's real value, the insurance company will now only pay for 50% of any damage that happens. It doesn't matter if the claim is big or small. You've basically forced yourself to become a partner in paying for your own disaster. Let's break this down with a real example you might see in your exam. So, a house is valued at 350,000 ringgit. The policy has a coinsurance clause saying you must insure it for at least 80% of its value. That means you need to insure it for at least 280,000 ringgit. But you only insured it for 150,000. Uh-oh. Then a fire in the kitchen causes 25,000 ringgit in damage. Let's see what happens. So, what's the actual payout? The formula is the amount you did insure divided by the amount you should have insured, and then you multiply that by the total damage. And as you can see, because you were so underinsured, the company is only going to pay for about 53% of the damage. You're stuck paying the other 12,000 ringgit or so yourself. That is the coinsurance penalty, and it hurts. Okay, so let's wrap this up. Here is your financial cheat code. First, the deductible. That's the fixed cover charge you always pay first. Second, the co-insurance penalty. That's the painful price you pay for underinsuring. Seriously, always insure for the required value. And finally, never forget the main goal of insurance. It's there to put you back where you started, not to make you rich. Look, understanding these rules isn't just about passing a test. It's about playing it smart with your money and protecting yourself in the real world. Insurance isn't a lottery ticket. It's a safety net. So now that you know the rules of the game, are you ready to play it smart?